This LOS is explain and evaluate how capitalizing versus expensing costs in the period in which they incurred affects financial statements and ratios. Capitalizing versus expensing. Impact on financial statements and ratios. In the period of the expenditure, an expenditure that is capitalized increases the amount of assets on the balance sheet and appears as an investing cash outflow on the statement of cash flows. In subsequent periods, a company allocates the capitalized amount over the asset's useful life as depreciation or amortization expense, except assets that are not depreciated, for example, land, or amortized, for example, intangible assets with indefinite lives. This expense reduces net income on the income statement and reduces the value of the asset on the balance sheet. Depreciation and amortization are non-cash expenses and therefore, apart from their effect on the taxable income and taxes payable, have no impact on the cash flow statement. In the section of the statement of cash flows that reconciles net income to operating cash flow, depreciation and amortization expenses are added back to net income. So continuing with capitalizing versus expensing the impact on financial statements and ratios, capitalizing therefore results in higher profitability compared to expensing in the first year. It results in lower profitability ratios in subsequent year. Conversely, expensing results in lower profitability in the first year, but higher profitability in later years, indicating a favorable trend. Depreciation and amortization of long-lived assets. Depreciation and amortization are effectively the same concept, with the term depreciation referring to the process of allocating tangible assets costs and the term amortization referring to the process of allocating intangible assets costs. Depreciation methods and calculation of depreciation expense. Depreciation and methods include the straight line method, in which the cost of an asset is allocated to expense evenly over its useful life, accelerated methods, in which the allocation of cost is greater in early years, and units of production method, in which the allocation of cost corresponds to the actual use of an asset in a particular period. The choice of depreciation methods affects the amounts reported on the financial statements, including the amounts for reported assets and operating and net income. This in turn affects a variety of financial ratios, including fixed asset turnover, total asset turnover, operating profit margin, operating return on assets, and return on assets. And that's the last slide for this LOS. Thank you.